I would try to stay away from advisors. Financial planning is very personal.
Most financial advisors sell mutual fund.
See if it gives you peace of mind.
What red flag should anyone watching out for when talking to a potential advisor?
The cost that you're paying into, 90% of the time we're talking about life. It's mostly three types, right? Commission, percentage. Next year will be the year when there's going to be more regulations.
Before the show starts, I would like to share a few words. When I first started to research for this podcast project, I have talked to many young people. And many young people felt they're very unsure about their financial future. Because of that, I have decided to dedicate the next 4 episodes to discuss different aspects of money and finance. And since money can be a sensitive and complex topic, I want to share a quick disclaimer. The views expressed in this episode are for educational and discussion purposes only and should not be taken as financial advice. Everyone's situation is different, so listeners should always do their own research and consult a qualified professional before making any major financial decisions. Thanks again for listening and being part of this community. Hello everyone, welcome to the PathForward Podcast. Today we're very excited to have Jonathan Low, one of the financial advisor and the partner of Rise Above Finance. Welcome to the show, Jonathan.
Thank you, Jackie.
Thanks to be here.
Yeah.
So let's talk about yourself a little bit first. What draws you to be a financial advisor?
Yeah, that's a very good question. Maybe I'll start with how I stepped into the field. It was, I think it's been almost 8 years. So 8 years ago, it's very interesting because in the very same month, I lost my pastor, who was a very good mentor of mine.
Oh.
And then also my mother-in-law got diagnosed with breast cancer.
Oh.
Yeah, so my pastor, actually, you might have heard, it's all over the news, one of the accidents at Peace Arch. So it was a very tragic car accident.
Yeah, the whole family.
Yeah, well, just himself. Like he left his whole family. So he left his wife, his 3 kids here. So it was just a very, very big incident. It had a very huge impact to our church and the whole Chinese community. And in the same month, 2 weeks later, we received a phone call and we were like, my mother-in-law is diagnosed with breast cancer.
Oh.
And so, growing up, you see all these things and you hear all these incidents, on TV and stuff like that.
Yeah.
But you never think about something like that happening in your own family, someone so close to you. And so at that time, it really had a huge impact to me and my wife at that point. I think we were married for maybe 2 to 3 years at that time. And so for us, we were always thinking, we're a young family, how are we going to make a difference in the world kind of thing. So we were still kind of quite young and we really wanted to, make a difference. And so I started asking the hard questions of, what if something like that happens to my own family, to ourselves, right? What if that happens to my friends or my other families, right? So, and so all the what ifs started, happening. And so I thought, maybe the easiest way to find answers is just to dip myself and step into the industry. And so we made a very bold move at that time. There was an opportunity in Hong Kong that came about. And so it was, I think, maybe within a few days, me and my wife just decided we're going to move to Hong Kong and we'll start over again.
Oh, wow.
And that's how I stepped into the financial planning industry.
Oh.
And so at that point, I started to become basically a financial advisor with Manulife in Hong Kong. And so that's how I stepped in. So, for the first couple of years, it was all about, okay, if something happens, do you have the right insurance? What's your backup plan? And then, of course, covering all the different aspects of financial planning as well. And even till now, I like to ask these hard questions. I think if I think back to my own childhood, my personality, I'm somebody who likes asking questions. with a caveat. I like asking questions, but I also like finding answers. So I'm actually one of those annoying kids who's always bugging my mom and dad, why this and why that, trying to find answers. And so I really like things to be very clear.
Mm.
And so clarity is one piece. And then at the same time, I'm also very risk adverse. So compared to other kids, I see it with my son now because he's very risk adverse as well. For example, his classmates are always like, playing and jumping and doing all these crazy things at the playground. But my son is the one who like holds onto the rail and try not to fall. And I'm one of those kids.
Oh.
And so I'm very cautious. I'm very reserved. And so because of that, I like to ask these hard questions, find answers, and also come from the perspective of being mindful of what risk is. And so, yeah, this is what clients can expect when I work with them, where I ask all the hard questions. I try to find clear answers. And that's one of the things that for myself, I like to see, when I look at numbers and I look at situations. These are some of the answers I try to find. I like to, when things are all over the place, I like to put them into order and find clarity.
Yeah.
And so it's just something that's wired in myself. And so I really like to do that.
Okay.
And so to kind of answer your question, that's part of one of the reasons why kind of putting all of those pieces together of why, it's been 8 years and I'm still enjoying, a day in and day out of being a planner.
So if we want to put it in context, at the core of your mission, what problem are you trying to solve for individuals or families, financially speaking?
Yeah, well, if I put myself into the shoes of, families, I have a son, I have a young family. My son is 5. Every day I'm constantly scrambling all over the place, get up, eat your breakfast, go to get that and go to this. And so, because of that very unique situation, I think families are, to put it simply, it's sometimes really life is all over the place. You're just really trying to get things in order. And so a lot of times, in this day and age, a lot of people, because of technology, you can easily Google things and find answers. So it's not hard to find answers, but it's very hard to find time to sit down and to actually put things into order and into context. And especially when there's so much information, if you just ask the prompt on ChatGPT, you'll get, A, B, C, D, E. Now, how do you know whether it's A or whether it's C that fits into your situation, right? And so for us, a lot of times it's putting things into order, into perspective, both in a numerical perspective, but also putting things into context. I think a lot of times people think of things black and white as if, even news, sometimes, some people might say, oh, like buying stocks is always better than, buying a mutual fund or something like that. But then I like to think that not everything is absolute. It's very context driven. And so, and this is something that, AI is not going to always be correct, because there's a lot of things that are, very subjective, that ties into personalities and values and brought ups. And money is such a sensitive subject, right? And so I like to think that, we're almost kind of like doctors.
Yeah.
Right? It's interesting because doctors do not diagnose themselves or their own family because there's so much bias. And in the same way, when we approach money, even for myself, looking at my clients' investments versus my own investments, it's a totally different dynamic.
Really?
I can treat a client portfolio very neutrally. They're just numbers. When I look at my own accounts and numbers, the day that it drops, I'm like, oh, what's going on? And so I'm also subject to the same emotional mistakes as an advisor. And so, sometimes you really do need that third eye perspective to put things into context, to bring a different perspective to put things into order. And there's something magical, when you involve a third party, and they're here, they're sitting down, and you're forced somehow to to proceed and to move forward with things. And so I'm not sure if I'm answering your question in terms of a mission, but I think a lot of it's delivering perspective and putting things into order, into context. And I think specifically for families, it's really, time, saving people time, and asking those hard questions. I think, like I said, when I look back to my own life, because you're always so caught up by, the daily motions, there's little time even for example, for me and my wife, to sit down to talk about, a certain subject. And sometimes those subject matters. It's not just, should we do A or B, but it comes down to a lot of asking those deep questions of, why, and what are our values, what is our calling, what are our directions. And so, it's a combination of, being a doctor, but also kind of like a coach/counselor, and asking those hard questions. And so, I really enjoy those conversations.
And I think that's exactly why sometimes people have a financial advisor, right? Because you're also subject to those emotional issues, right? When you see like things go up and down, or like things just don't go the right way that you want, you have an emotional reaction. That's why you have to have a third person to put in perspective. But let's move on to something a bit more technical. I think let's just talk more about financial advisor as a profession itself. So when it comes to choosing a financial advisor, the term fiduciary often comes up. So can you explain about what does it mean and why an advisor is a fiduciary?
No, that's a very good question, and it's so interesting to hear that term from you, because it's not always brought up from clients. We talk about it sometimes, and then clients are like, what exactly is that big word?
But I noticed though, actually some of the advisor is not obliged to be fiduciary. I'm very surprised.
Oh yeah, there is no mandatory standard in our field to be a fiduciary. So unlike lawyers, for example, like lawyers are fiduciaries, like there's a license and supposed to what fiduciary means, essentially it's standing in the client's best interest, right? And so that fiduciary duty is not part of our licensing. And so it's really a matter of it's really dependent on advisors, perspective, and their integrity and their values, whether they want to adhere to this standard of being a fiduciary.
Oh wow! I was very surprised to find out about that. So which is a good way to ask the next question is, what credential or designation should we pay attention to when we choose a financial advisor? Should it be like a CFP, a CFA, a CPA? Like that's all like those short term. Like what do those mean? And what area or expertise training does this credential should cover? And how should it benefit the client?
Mm-hmm. I think further to what I was talking about, I think even though there are no licensing requirements to be fiduciaries, but for CFPs, so what CFP is Certified Financial Planner. So that is a specific certification you can get as a planner, and so CFPs do have a fiduciary duty. So part of that certification, and so sometimes it's nice to be looking for a CFP, and so for example in our team, Ivan is a CFP, and so Certified Financial Planner, and so for CFPs, you have to go through a very comprehensive exam. There are certain years of experience you have to be in the field before you can get CFP. So I am actually in progress of completing my CFP sometime this year. And so That is definitely one designation to look for. So CFPs, you can treat it as if it's more for financial planners. So kind of like a general family doctor that oversees the whole financial picture. Some of the designations you mentioned, whether it's CFAs or what was the other one?
CPA.
Yeah, CPAs. So
Yeah.
yeah, so those are more of like specialists. It's almost kind of like specialists in the medical field, where CFAs are analysts by trade, and so they're the ones certified to do more analysis when it comes down to investment portfolio construction. And so CFAs actually goes through even much more comprehensive exam with a lot of requirements, a lot of years of experience. And so it's not easy to get a CFA.
Oh.
And so if you're able to find a CFA, an investment advisor, or a portfolio manager, it really means something that they've gone through some very rigorous training. They are really, recognized in the field to get to that level of expertise when it comes down to investment construction. And of course, CPAs are accountants. And so they specialize on, the accounting, taxes, and tax returns and stuff like that.
Okay.
So each designation comes with different expertise. And so, well, first of all, I think the question is, what expertise are you looking for? So is it an accounting question, or are you just not sure and you just want someone to put things into order as a GP? And so that would determine what kind of professional you're looking for. But I also like to think that sometimes it's not just about the certifications, because certifications are really just educational requirements, right? And so it's a lot of book knowledge.
Yeah.
And as an advisor myself, being in the field for 7-8 years, I've seen so many people with so many designations, but then when you talk to them, you realize a lot of it is book knowledge, and they're not as proficient in terms of applying it. It's sometimes it has to do with whether they have enough experience or exposure to different types of clients or different types of backgrounds. And so sometimes it's helpful to even ask for their own experience. And so in the financial field, you can get different exposure in the field. So for example, I come from more of an insurance background. And then when I moved back here, I started to do a little bit more of holistic financial planning that covers different areas. But there are also professionals that has more of a banking background. So banking background would have less exposure to insurance, and it's mostly investments. But bank structured environments are also very wide, very differently. There are a lot of corporate quotas to fulfill and deadlines to fight for, and so sometimes their experience is more on the banking sector and how that's structured, right? So they might have less exposure to more of a wide verse of different products and tools. Whereas, some folks might come from more of an independent background, right? Where they have a lot more exposure to different things. And then you also have some that have more of a stronger portfolio management background, right? So maybe they've been in trading firms or fund companies where they are actively trading and managing big funds, big entities. And so they would have more of the exposure of actually trading and selecting different securities in a investment. And so different expertise might come with different perspective when they're giving advice, right? All of us can come from a perspective of acting as a fiduciary, but at the end of the day, the experience really determines the quality of advice, right? And the educational or certification is just the backbone, right? And then, of course, at the end of the day, there's also just a matter of whether personality-wise it's a good fit, right? So, for example, our firm, we have the three of us, and the three of us are good fits with different types of personalities, right? And so it's important to really sit down, get to know that person, right? When you're looking for a professional, see if it gives you peace of mind, where you feel like you're comfortable in sharing more about life. Because I like to think that, financial planning is very personal, right?
Yeah.
Sometimes our conversations, 90% of the time, we're talking about life more than just numbers.
Yeah, it is very true. Yes.
So, you want to be comfortable with that person in talking about life, right? In sharing some of the even struggles, right?
Yeah.
Difficulties you're going through. Because the more transparent you are, the more help you can get, actually.
Yeah.
And the more accurate advice you can be receiving from a planner.
Okay. But what red flag should anyone watching out for when talking to a potential advisor?
This episode is brought to you by JW Music Studio. We offer piano and guitar lesson in both group and private setting. Group lesson is a great way to ignite a student's musical interest. It offers engaging activities that will reinforce specific skill sets. Ensemble playing will strengthen their rhythmic feeling and listening abilities. Most of all, they will experience the joy of making music with others. Contact us to find out our available schedule.
Yeah, I would say I would try to stay away from advisors who are very product driven, who are very transactional. So I'd say if I look at our field very simply, there's maybe more or less, actually nowadays there's more and more advisors who are coming from a background of wanting to create an experience that is advice driven more than transactional driven. But the traditional financial planning industry is structured in a very transactional, product-driven way. And so, therefore, even till this day, I would say 80-90% of our industry is driven by commissions, for example. And so, for example, when I first stepped into the industry as an advisor, I had no base salary.
Yeah.
So my compensation 100% is based on commission. And so it's really about, you're trying to, basically you kill whatever in order to get an income for yourself. And so therefore, because of that, sometimes you are forced, to it's not that I want to treat a client or treat an experience to be transactional, but the way of how you're compensated, you're somewhat forced to act in that way because you have to meet quotas and you have to feed your family, and so sometimes it almost turns the conversation differently, where when I step back, I really do ask that hard question of am I acting in the client's best interest, right? And sometimes that question, it's hard to give a black and white answer because there can be so many different variables, right? And so therefore, if, for example, nowadays for us, we're always asking that question of, how can we turn that financial planning conversation to be less transaction, to be less product driven. And sometimes when clients come to us, they might be asking, which insurance should I be considering or which investment should I be selecting? And a lot of times we're like, okay, hold on for that 1 second. We'll get to that question very shortly, but we want to, consider all these different aspects when we understand what's going on on your life before, we answer that question. So it's almost kind of like, for a doctor to prescribe the right treatment and medication, there has to be a right diagnosis for all, right? And so, the red flags would be, if a planner is just trying to close a sale to turn that conversation to be very product and transactional driven, I would try to, shy away from that because you definitely want to at least have a proper conversation to properly look at a diagnosis and a full assessment first. That's advice driven before we even look at, the medication and the treatment and the prescription and stuff like that.
Well, actually, that answer surprised me. Because, and I think in recent year, this type of thing become very controversial. In a lot in the business field, particularly in the finance field. And the next part I really want to ask you is about fee, which is one of the controversial subject. Which I don't know why though, but I don't know why they make it become such a big thing for financial advisor. But can you explain the different ways a financial advisor typically charge for their services? You have mentioned that a lot of advisors receive commission. Beside that, what is other way that they can charge for their services?
Yeah. So I already mentioned commissions, right? So that's one way. And how commissions work is that, in the client's perspective, there's not a out-of-pocket cost, right? Once the transaction or product is implemented or completed, then the financial institution will issue a commission, right? So the commission is usually a percentage of, either the premium or the cost that the client is really handling to the company, and so there is a cut to it, right? So that's one way. And then there's the other way, which is percentage of assets. And so we call AUM, so assets under management. So for example, for some firms, they might be managing a certain amount of assets. They might have a minimum threshold. And so it will be a small percentage, maybe 1%, 2% or whatnot, taken out monthly or annually. So that's one way. And then you also have the fee-based, right? So it's a very clear basis of a flat fee that the planner is charging, as if you are, going to a doctor, accountant, lawyer, of a flat fee, right? That charges for the plan or for the quality of work. And then of course there's some, planners who might charge a hourly fee or something like that. So if I have to sum it up, it's mostly three types, right? Commission, percentage under management, or a flat fee.
Okay.
And then of course, these are the three ways, but we've seen, for example, some planners doing a hybrid of a little bit of all three, right? And so it depends on preference, but of course, I like to think of it that's fair, right? And that's win-win, because obviously, in a client's shoes, commission can be very appealing because there's not an out-of-pocket cost to it. But at the same time, I mean, in this world, to put it very bluntly, there's not a free lunch out there, right? For the institution to be paying a compensation, the compensation has to come from somewhere, right? So with the cost that you're paying into, essentially it's just a cut of it, right? It's being paid into it, and so the questions we really want to ask is, the quality of advice and the conflict of interest behind it. So to my earlier. To our earlier conversation, when it comes down to a product-driven conversation, if we look at it in a perspective of win-win, to the planners, under a planner's hat, if they're not charging a fee, and it's 100% based on commission, then for them they really do have to complete the transaction in order to compensate the time or the input they have put in, and so therefore that closing of the product is very essential, and so. The hard question would be, whether the product is actually a good fit, or is, fiduciary in nature in terms of giving client the best interest is questionable, right? Versus a fee base, right? You do have to pay an upfront cost to it, but then it's very fair because you are, the planner is compensated for their time. You're essentially paying for the expertise and the quality of advice, right? And so each way there are pros and cons to it. The question is, what exactly are you looking for? So that's very important.
Okay.
But I think from our perspective as well, of course, I think everybody wants to be respected and treated
Yeah.
with a value, right? So for us, I definitely come from a perspective, having gone through different hats. I've gone through, commission based. I've gone through percentage based, and now fee based. I definitely think that I like to be, valued in terms of my time and expertise as well. And so I think that perspective is very important as well.
Yeah.
Yeah.
So at the end, is who are you talking to? Which financial advisor you're talking to? I guess what kind of value they can offer to you too, right?
But I'm curious. You mentioned that it's very controversial, and nowadays, like, what have you been hearing so far?
Well, I think what I see a lot of time is, I think is mainly in the traditional sense that most financial advisors sell mutual fund, but nowadays a lot of them maybe self-driven advisor, like like retail investor they call it.
Yeah.
So they would purchase ETF because
Yeah.
ETF it just simply has a lower fee.
Yeah.
Well, but that's actually not always true too, like because ETF just have so much thing nowadays. And oftentimes I see advisor onto TV and then explaining these kind of things, they seem to be very uncomfortable. Why mutual fund is more expensive and why ETF. I think that is just one of the example, right? But yeah, so like this type of thing, I don't know why the advisors seem to be like, sometimes when advisor being asked this type of question, they're very uncomfortable. Which I don't know why. I mean, like mutual fund has, like what you say, mutual fund has pros and cons, and ETF has pros and cons.
Yeah.
And not all ETF make equally,
Mm-hmm.
right? And I think that's a lot of time investors do not understand that. And then now there's active managed ETF and there's passive managed ETF and all those things. But anyway, it's not my podcast.
No, I think transparency, I think is a, I don't want to say it's an issue, but transparency has been one of the key subjects in our field. And I think the regulators are trying to ask for more transparency.
Yeah.
And of course, I think the public is trying to look for more transparency. And so actually, I think there's been different phases of rules and regulations in place that are encouraging more transparency when it comes to fee schedules. And actually, next year will be the year when there's going to be more regulations that require all investment products to disclose very in detail of all the different charges. And so for example, traditionally mutual funds or ETFs, you can just write, there's an MER of 2% or 3%, and that's it, right? But starting from next year, there has been a very detailed, breakdown of what that includes, right?
Yeah.
And so sometimes it is very tricky because in financial advisory, because you're talking about money and it is very sensitive, but at the same time, we're always talking about compensation. So it almost feels like there's a conflict of interest.
Yeah.
It's almost kind of like there's the elephant in the room, and it's difficult to address it. And especially sometimes because financial products can be very complex. Like you said, permanent life insurance is very complex. Of course, there's the perspective of whether someone is acting as a fiduciary and actually delivering a product that's centered in the client's interest. But there's also the other part where, because it's so complex, and sometimes it's more important for some clients to actually move forward in making a decision. Because sometimes to make a decision, it's just impossible to understand things, or to put it differently, depending on a client's capacity and situation, sometimes it might not be the best fit or most suitable for someone to actually understand all the very detailed dynamics of a certain aspect before you make a decision in, implementing a certain product, right? And so sometimes it's just a matter of there's not enough time, or timing wise, it's just not suitable to go through all the very little details that's there before proceeding with the decision. And then sometimes, the communication just got lost. And so there are things that might be misunderstood. And so therefore the client might feel like, they did not get what they were expecting. And so there's a lot of controversies that has arise. And so, we hear a lot of these stories, constantly clients are coming to us in, trying to seek for answers with these hard situations. And there's no situation that's black or right, black or white, or sometimes it's not just right or wrong. It's just a lot of different variables.
Yeah.
But I think taking responsibility, both as a planner, but also as a client, in understanding what you're purchasing, is very important.
Yeah.
Having good communication, setting the right expectations, and as a planner, these are all very important things. In the conversation.
Yeah.
Yeah.
Well, but I mean, like what you say, right? It's at times it's very complex for this type of subject. I don't even know how can you be completely transparent when if you're not educated yourself at all in the financial product that is offered to you.
Yeah.
Right. So like what I say, like ETF don't make equally. They're not all the same thing, right? So and that's why they charge differently too. But are there fees within financial product that client often overlook or don't even realize they're paying for?
Fees. Well, I think for the most part, usually the fees that most clients do not realize come from mostly investment products. So I think investment products are the I would say are the scope that that is I would say that's most not transparent.
Okay.
And to some extent. Because a lot of them are hidden, for example. So depending on the type of product, some products are very transparent where you actually see that transaction.
Yeah.
But even so, most of the time it's deducted from the investment account by itself, right? Or some, for example, mutual funds, a lot of the fees are actually deducted from the fund price. So you don't even see it. You just see the fund price. Yeah. So you would just see whether the whole mutual fund went up or went down, right? So these are all fees that probably some clients are not aware of. And so, like I said, the regulations that are coming up are requiring, advisors and companies to be very transparent in disclosing those fees. But still, because they're all deducted from the account, unless you actually, look for the statement and really kind of dive deep into the account and to look at those transactions. Otherwise, you probably don't know you're paying it for history.
It's true. Yeah.
And so that's probably one of the items to look for.
Okay.
Right? If you want to understand what fees you're paying.
Yeah.
But I mean, it goes hand in hand. I think depending on culture and different personalities, sometimes we do have clients who are more, sensitive when it comes down to wanting to understand more about fees. But of course, the fees you're paying, at the same time, you also want to consider the value that you're getting.
Yes.
Right? If you're paying a certain fee and you're getting, really great value, well, that's great, right? Because, you are paying for something that has value in it, right? You're receiving something out of it. I think the caveat is always when you might be paying a fee and you're not getting any value out of it.
Yeah.
We have heard of a lot of instances, for example, where, clients, might feel underserved, whether it's the advisor and just never contacted them, or, lack of follow-up, or maybe they've, bought a mutual fund from the bank and they just feel like the bank never really engages in a proper conversation with them to get the advice they're looking for. And so I think it's a matter of asking, are you getting what you're expected to be getting? And really getting an idea of what you're looking for. I think having clarity over that question is more important than just the fee itself. Right.
Yeah.
Because you might be paying a fee, but if you are getting what you're expected, then perhaps the fee isn't really
It isn't a problem.
right.
Yes. So I guess the expectation part is very important. I think you have to ask yourself first when you find a financial advisor. But do you have client actually, when they meet you, they would very clearly tell you, okay, this is what I expect from you? Does it happen often, or they also don't know what they're looking for?
At JW's Music Studio, we offer more than just music lessons. We also nurture future leaders in music education. Our Piano Teacher Apprenticeship Program is an initiative designed for advanced piano students who are ready to take the next step from student to teacher. This program provides a structured, supportive pathway into music teaching. Participants are mentored through every stage, from interview and training to guided teaching and independent lessons, all while being compensated as they grow. Whether your teen is exploring a career in teaching or simply wants to deepen their connection to music, this program offers real-world skills in a safe, encouraging environment. Contact us today at jnwmusic@yahoo.ca.
It depends. So we have clients who come to us who really know what they're looking for. And so, yeah, I mean, that would be great, right?
Yeah.
But I also have to admit that I would say most clients who come to us, usually there are some triggering questions. So maybe something happened in life, or they read this, or maybe something shifted, and now they have to, make a certain decision, whether it's maybe buying a place or selling a place, or, they're, transitioning to a different job or something like that. So there usually is a triggering question. But because, it's interesting because a lot of clients come to us and they're like, I don't know what I don't know.
Well, that's very true.
And that
is very true. That's a very valid question.
That's a very valid question. And so because of that, I would say most people actually do not know, what they're looking for, because they don't know what they don't know, right? So, and so I think it's part of our role to clarify and to find out what that is. And so I think it goes back to, the very first question you asked of, why am I in the field? And so I like to approach every client in trying to find that clarity to that question.
Yeah.
Okay, what exactly are you looking for? What exactly can I deliver to actually fulfill whatever question you're looking for? Because most of the time clients are coming with a question.
Yeah.
Or they're finding to look for an answer.
Yeah.
But the tricky thing is, if you don't know what that answer is, and if you're not able to verbalize it, I think it is tough. So it is quite a bit of a conversation sometimes to find out what that is. But I always feel so overjoyed every time when I see somebody walking out of the room, or maybe doing some planning with us over a period of time, and then they walk out finding a lot more clarity, knowing what their direction is, knowing how to move forward, feeling like they're making progress, because that's so important. And I think that's extending not just financially, but just in life in general. When you are able to confidently express that you know how to move forward, I think it shows a lot. It will apply to a lot of things in life. And so that's one of the most rewarding things.
Well, and I think that's come back to it, like, to know whether your fee is getting the value. That's what it is, right? Is this person really understand what you're going through? What's in your life, what you're looking for?
Yeah.
What's your value? I think it's kind of funny that even though it is talking about money, but essentially the important question is not about money.
It's not about money.
Right?
It's never about money.
It's never about money. And that's the other thing I really want to talk to you about. You mentioned you're risk averse, which I'm kind of surprised. Or I should not. I mean, different people are different. But there is a relationship in investment generally speaking,
Mhm.
between risk and return.
Yep.
Right? Can you explain how do they relate in a very simple manner?
Yeah. Well, risk, to put it simply, is uncertainty.
Yeah.
But if I have to break it down very practically, it's essentially something that you're choosing to compromise
Yeah.
in order to get a return, right? And so risk is there for every single decision you're making,
Yeah.
right? Even right now, whether I choose to stand or sit, well, if I really have to break it down, there's a risk and reward to it, right?
Yeah, that's true.
I'm sitting down, right? I'm risking the chair falling down,
Yeah.
right? But if I stand up, I'm risking, my feet, feeling tired, for example, right? So at the end of the day, especially as you grow older, you realize that everything comes with a not so much a compromise, but a cost. Yeah, maybe to, actually put it very accurately, it's a cost that you're paying. And I think to the earlier question, there's always a cost to value that you're receiving. And so it's really at the end of the day, how much cost you're willing to pay for the value or the return that you're receiving, to put it very simply.
Yeah.
And so same thing with investments. There's a lot of people, especially nowadays with TikTok and everything, feel like, getting good return is easy. But if we really have to break it down, there's always a cost to it,
Yep.
whether that cost has been realized, right? It's been great for the past couple of years that it's been mostly, bull markets, the market's going great. And a lot of people are coming in without actually realizing that cost yet.
Yeah.
But wait till you go through a complete economic cycle, and when the market actually rebounds, that's where the cost actually comes in.
Yeah.
Right. So yes, a lot of times, depending on the cost and the willingness to bear for the uncertainty, and there can be potential, greater return. So that's essentially a lot of times what risk and return is.
But there are different type of risks too. Let's get to it a little bit more. What type of investment risk a client should be aware of? Like, for example, should a client be aware of an inflation risk, or a market risk, which you have mentioned it because economic cycle go round, right?
Yeah.
That would be the market risk that you're mentioning. But do you think someone should concern about such as like an inflation risk?
Yes. So I think earlier what I was mentioning is more of the macro level of what risk is. But if I really have to break it down into investment, right, what kind of risk do we have to consider? Well, first of all, immediately it would be the market risk of the volatility. So a lot of times when we're talking about risk, it's really about the market volatility, the ups and downs of the market. And so depending on the different investments you're choosing, there might be different dynamics in terms of ups and downs. So the ups and downs can be in a range of 5%, 10%, 20%, all the way up to 50 or 80%, right? So depending on the volatility you're comfortable with, there might be a potential high return or lower return. So that's one thing. And that leads to liquidity risk, right? So easeability in whether you're able to cash out the investments. Yeah. So for example, if you're bearing a higher volatility, so there's higher ups and downs, well, the last thing you want is that you really need money or cash, but the market's down 30%, where now you're liquidating a loss, right? So liquidity risk is one thing. And of course, out of the very diverse range of products out there, there are some products also that might have a certain period before they mature.
Yeah.
And so sometimes you might not actually have the option of liquidating, or if you liquidate the investments, you actually might be able to just cash out a very small amount, right? So that's another risk sometimes that we talk about. And then inflation risk would be the other way of the spectrum, where if you don't do anything, if you just park it in cash, well, inflation has been pretty high for the past couple of years post-COVID, right? So if you're not getting any return, well, you also have that risk of, your money losing value. So, and so it kind of comes back to my earlier point of, whether I'm standing up or sitting down, there's still a risk to it, right? So some people might feel like, man, for example, for me, I'm more risk adverse. And so the first thought in my head sometimes would be, I probably should just park it in cash and not invest into the market because I don't know if the next crash will happen, right? But then my thought actually comes with that risk of inflation risk, for example, that's true, right? So while we also have other clients on the other spectrum where they're very active in the market, they're trading, but then there's also a absence of acknowledging that, there's liquidity risk and volatility risk. Well, what if something, what if your roof breaks or what if you get sick? Do you have enough of a cushion to handle those things? And so it goes hand in hand. So we would have to really address it from a neutral perspective because it's impossible to address all risk all the time.
Yes.
But we want to balance it, right? There has to be a good balance where we're addressing the main risk, the risk that comes with the biggest downfall or downside. So we're trying to minimize it, essentially.
But do you think that's a sign that indicate that an investor may be taking too much risk at the moment?
Well, without going into too detailed in terms of, portfolios, investments and stuff like that, I think the first question is liquidity, right? I think across all life stages, you should be having at least 3 to 6 months of emergency fund.
Yeah.
You should be thinking of, okay, if the roof leaks or if you get sick or if a family member passes away, especially for those with children and family or mortgage, right? You want to be asking those hard questions. And if you don't have the proper plans in place, well, for you to be putting all your money into a 100% equity kind of portfolio, there is some risk to it, even if it's going to go up, right? So, because, nobody has a crystal ball. And, and even if you even ask the most professional portfolio managers, fund managers, they're going to tell you the same thing, especially in this market environment. Sometimes we practically do not know what, the leaders of different countries are going to what decisions, right, they're going to make, because they're always, surprise us to some extent. So, so you always want to make sure that, okay, at least your emergency situations are all covered, before you make those, higher risk, investment decisions. And so that's the first question to be asking. And then, of course, depending on different life stages, you also want to have portfolios that are more in line with your goals, your values, and your life stages. For example, somebody who is closer to retirement or in retirement stage should probably consider, de-risking their portfolio, especially if you expect you need to draw an income or draw an amount from the portfolio. So in a general sense, we would always look at time horizon, for example. We would look at, okay, how soon do you have to actually be cashing out your investments, whether it's for an income or you need to buy a car, buy a house. Well, if it's within the next year or so, you probably should be either lowering your risk or you should actually even start withdrawing. The last thing you want is, you need to buy a car in the same month the market tanks 30%.
That would be unfortunate.
Yes, very unfortunate. So those are the things that I would always look for.
Which is I think is a good segue to talk about the next thing, which is the return, right? Because you're mentioning about time horizon and all that thing of this term.
Yes.
But first, I just want to address the term return first, because there are many different ways to look at return, and I always get confused. I didn't be very careful. Okay, what kind of return this person is talking about, right? That's real return, annualized return, nominal return, to just name a few of them. And I think that's, that's even more. And on top of that, you can also look at it at different time period, right? Because you can look at the market at the time of outperformance or at the time of underperformance. Mm-hmm. That would bring you a very different picture of whatever product you're looking at. So what would be a good way for a client to think about return? Maybe this is a really hard question to answer. Like, how should they measure and have a realistic expectation for it?
Yeah. Well, first of all, I think what comes to mind for myself is, well, first of all, to be clear what the goals are. Right. Because realistically speaking, there can be a wide range, right? I've seen clients getting 100%, 200%, 300% return in a single year, just because they chose just so happened they're lucky and they chose the right stock, right? So, the return can be endless, right? But, going back, we really have to look at, well, first of all, what are the goals, right? For example, what I usually like to do is to look at, let's look at the long term. What are your needs for retirement? Because it's interesting. Every time I ask about goals, well, 90% of clients cannot tell me an answer of what their goals are. And I totally understand, because if you ask me that question, I would have trouble answering that as well, because, anything can happen, right?
Yeah.
And sometimes it's hard to really narrow down, okay, this is exactly where I want to be in the next couple of years. It's difficult. So sometimes I like to, well, let's look at the goals that are going to be here regardless, right? So, sooner or later, there will be a point when, we won't be working. So that's retirement, so-called. So, for example, retirement. And I will look at, okay, how far are we from retirement? What are the potential needs for retirement? How much income do you need? How many years do we have? Then we have to break it down. Okay, what is your progress? So how much do you have right now? What's coming from the government? Do you have a pension? Do you have RSPs? And then when we look at the shortfalls, okay, this is how much you might have to save. And then for your funds right now, this is how much return you will have to achieve in order to get to, where you need to be by retirement. And so this would be what I call measuring from a perspective of return. Then that way it will give a lot more peace of mind, because you're not constantly comparing yourself with other people. And again, a lot of times money is not about money. It's about life. Right? Are we comparing ourselves and our identity with other people? Right. So that's one perspective. But of course, realistically speaking, looking at the economy and the market benchmark is definitely one thing to be aware of, especially when you're evaluating, okay, is whatever product I'm choosing, is that a right fit? Then sometimes we do have to come from a perspective of a neutral perspective of looking, okay, how is that product doing in comparison to the benchmark or the market itself, right? For example, the whole movement of ETF nowadays, it comes from, people in mutual funds, and mutual funds used to say that they're trying to beat the market, but then they're not doing. Yeah, they don't. So now people are like, okay, let's just invest according to the market, because, the risk will be the same, but the return will be the same. And so the benchmark is therefore very important, right? Looking at the market benchmark and the economy. So, for example, if you're noticing, your investments, they're not doing so well in a certain year, well, perhaps it might be worth your time to actually look at the economy and the benchmark. Maybe the benchmark is not performing as well.
Yeah.
And so that explains why. But of course, there is a caveat to that. Like, the benchmark is not everything, right?
Yeah.
For example, the S&P or NASDAQ, that's what a lot of people look into. Well, those are just comprised of the US market itself. It's full equities. It's only, the largest companies in the States, which comprise of a lot of tech stocks.
Yeah.
And so if we really have to break it down, it only represents a certain sector of a certain country, which usually comes with the highest growth, but also the highest risk and volatility. And so, for example, if you're invested in a mutual fund, well, most mutual funds are not 100% equity, and they may not be 100% US. So you do want to definitely look for the correct benchmark because you want to compare apples to apples, right? A lot of people come to us and they're like, well, why is your fund not performing? I'm looking at S&P and it's giving me 15% this year. I'm only getting 8%. And I'm like, well, we're not comparing apples to apples.
Oh, yeah, that's true. That's true.
Right?
Yeah.
So that's another thing to consider as well.
Because you have to, like what you said, you have to put the risk perspective in it too, right? What's the cost for you to get this type of return?
Exactly.
And sometimes people just don't see that, right? Now, you mentioned about time horizon. So do you agree that focusing on long-term result is more meaningful than the year-over-year performance?
Yes and no.
Okay.
I think in a general sense, investing with a long-term horizon is one of the key ideologies out there. A lot of people are talking about, okay, what are some good fundamentals of investing? And that's usually one of them. And it's not wrong.
Yeah.
But it's also very situation specific, right? So it goes back to the goals, right? So for example, I can't tell a retiree to focus on long-term if they need to get an income from their investments tomorrow, right? So, but there should always be a component of a long-term view in a portfolio or in a financial plan.
Even for a retired person?
I do think so.
Oh.
Because most retirees, if they have some assets or some retirement assets, obviously they do not have to be, using the entire amount right away, right? So it would be important for us to look at, okay, how do we separate those into a couple of different phases, right? Where, some phase we don't anticipate we have to use them yet, maybe until 10 years later, then maybe that component can be invested with a longer time horizon. Versus there might be a part where we can liquidate it earlier to supplement the income. Well, that part should be invested with a shorter time horizon, right? So I think going back to the fundamentals of investing, in some sense, if there is capacity and time to be investing in a long time perspective, then yes, we should definitely do so. That's going to be the biggest value to lower the risk as much as possible while being able to get a high return. So because that, for example, you can probably ride through multiple different economic cycles and you can get a good overall return. I think one thing that a lot of people misunderstand when they look at return is that they just think about a linear kind of return. So they think, okay, 8% this year and then 8% the next year, and it just goes and goes. Well, in reality, it's sometimes kind of like, 20% and then 15% and then down 20% and then go up again, right? So a lot of the numbers that you're hearing out there, SMV is doing 8% return. That's just an average of, we're talking about 30, 40, 50 years, right? In reality, it's so dynamic. And so keeping it long-term, therefore, is very important because if we really want to look for that stable return, it has to be structured long-term. But then depending on situations, there might be components that needs to be structured shorter term. And so if it's strong shorter term, then the year-over-year return or performance may be very important in that case. But even so, for example, if a client comes to us and they're like, I have to buy a car next year. Well, we're not going to tell them to put it into a full equity for that. No. We're probably just going to tell them, well, put it in a savings account or a GIC, right? That's probably your best bet. So I think for somebody to be expecting to get a double-digit return within, a single year or two, I'm not going to say it's impossible or unrealistic, but then the risk you are taking on is huge.
Right.
Yeah,
that's true. Yeah.
Right. So.
Wow, thanks so much. I feel I had learned a lot actually. It was really a great conversation to have, with you, and makes me kind of think I should look at my financial picture and ask those hard questions as well. Thanks so much to be here, Jonathan.
Thank you for your invite.
Yeah, thank you.